Hi, welcome to the Interaxis YouTube channel and Interaxis.io. Today we're going to talk about insurance and hedging. Now eventually I want to get into how decentralized protocols and decentralized ledgers and blockchain and everything are going to impact insurance and hedging in the near and the midterm and the distant future. But to do that I have to go back from a traditional standpoint and look at insurance and hedges and how they work traditionally. Let me say a couple pieces of housekeeping. One, I'm not giving any sort of investment or financial advice. I'm not telling you you need to buy any of these products or buy any of these investments or anything like that. I'm just talking about what they are and a little bit about how they work. That also being said, I'm going to talk a little bit about things like life insurance and disability insurance. I'm going to mention them. I am licensed to sell life insurance and get a commission on it, so I just wanted that out there so that you all understand I'm talking about it. I'm not trying to sell it, but I am licensed to sell it. If I needed to, I could get compensated on it, but not in this particular venue. So here we go, insurance and hedging. First, we're going to talk about how these are part of risk management. Okay, and a lot of investing, both personally and a lot of what companies try to do, businesses, is risk management. It's identifying, okay, what can go wrong? What can pull down the value of my business or the value of my personal holdings or my life or something like that? And then what can I do, if anything, to help manage that risk, either mitigate it or transfer it, or am I just going to eliminate it altogether, right? Elimination of a risk in your life might be, well, if I'm really worried about airplanes going down, for instance, I'm just not going to travel by airplane, right? That's one way to eliminate risk altogether. For what you do for a profession, it might be fine. It might be fine with your lifestyle. I like to travel a lot. I kind of need airplanes. I'm going to accept the risk that at some point an airplane that I'm on could go down. It's a very low risk because to me it's worth the risk because I really like to travel. Okay, so insurance and hedging, however, fall into two categories. First, we're going to talk about insurance, and insurance is really risk transfer. Okay, what that means is I am transferring the risk. I am transferring that risk onto someone else, onto another entity. And that entity is usually the insurance company, which is obviously a centralized entity. And what the insurance company has done is they've taken whatever risk that is. So let's say in this case it's life insurance. What is the risk that I will die in the next X number of years? Okay, they've evaluated that and they've done what's called underwriting. Okay, and they've determined that here's the risk. Here's where I fit on a chart in terms of what is my likelihood to die in the next X number of years, and therefore I pay a premium. And if I die in those, say, 20 years, then the insurance company is going to pay my family or my beneficiaries a benefit, a death benefit. Okay, so I've paid a premium, and if I die, my beneficiaries are going to get this death benefit. All right, they're pretty sad that I'm dead. Hopefully, they're sad about that. However, there's money to replace, and why do I want that? Because to me, the fact that I have, we'll call it another 30 years to work in my life and to earn an income, to me, that's worth paying some money now. I've managed my risk. I'm evaluating what the risk is that I might die prematurely, and it's a pretty low risk, but if it happens, it's going to be a huge financial impact. So I want to transfer that risk onto someone else, and in this case, the insurance company, because the premium I have to pay is relatively low compared to the negative financial impact it could have on my family. So that's a risk transfer in the personal perspective. You do the same thing with auto insurance, homeowners insurance, liability insurance is a big one. Liability insurance is what happens if I get sued, right? If I cause a car accident and I get sued and I'm liable for that and I lose a suit or whatever, I have insurance to cover that because financially that could be devastating. I know the chances are it won't happen, but if it does, it could be devastating, and the premium I pay is relatively small. So in my financial planning, I've decided that's how I'm going to manage that risk, is I'm going to buy insurance rather than trying to avoid getting sued, because it's really hard to avoid that because I don't know when it could happen, but I know that I have insurance to cover it. So that is risk management, risk transfer insurance in the individual world, in my world. Now, where that happens in a business setting is a business might have something like business interruption insurance. All right, I live in Houston, Texas. We've had a lot of floods recently. Businesses, had days, weeks, months where they were out of business. They might have lost stock, their revenues were down. So they might have business interruption insurance. It says if they can't do business for some period of time, right, they've paid a premium to the insurance company, and if this event happens, they will get paid some benefit. Now, they are not looking to benefit. They're not hoping that this happens. This is not good for business, but what they want is to be compensated, right? To be not fully made whole, but to get something in return if this event happens. And this event is usually something that has a relatively low chance of happening. All right, if you insure it, it's probably because it has a relatively low chance of happening, but if it happens, it has a huge financial impact. So you have business interruption insurance in that case. A lot of businesses also have flood insurance. They have, like I have, E&O, errors and omissions insurance. This is if I do something wrong from a financial advisory perspective and my clients sue me and I was just patently wrong about what I did. I did the wrong thing for them and they win, my errors and omissions insurance probably covers it, right? You have things like malpractice for doctors and lawyers, right? If they do something wrong in their practice and they get sued, their malpractice insurance probably covers it, and they pay a premium every year, and they're probably, bitching and moaning about it when they have to write that check, but if it ever comes to the time when they get sued, they're going to be happy that they have that insurance at least to cover it. Okay, that's where insurance works from a business perspective. There are plenty of companies in, say, the shipping industry and such, where they will insure their goods or their cargo as they're in transit, right? They have to insure that because if something goes wrong in the meantime, in that transit, they want to be compensated, right? Someone has to be compensated, but there has to be a centralized insurance company that is willing to underwrite, meaning they're willing to evaluate the risk, evaluate the likelihood that that's going to happen, and therefore how much might the insurance company have to pay out in a benefit. And then what the insurance company also has to do in order to have enough of this is they have to have enough people paying premiums in here, enough companies that need that particular type of insurance, need that risk transfer, to be able to make that insurance even worth it. Because if there are only 2 or 3 companies that need that insurance, right, they're not going to be able to pool enough premiums that if one company has this incident happen, the insurance company isn't going to have enough money to pay them out. So if it's something that only 2 or 3 companies in the world need, well, there's probably not going to be insurance sufficient. There's not going to be a need sufficient for an insurance company to write that. Okay, a lot of insurance companies will just take on the risk and know that they have so much money that they can take it on. But for the most part, if there aren't enough businesses or enough people that need some sort of risk transfer, there's not going to be an insurance company willing to underwrite that type of insurance. But insurance is very important from the perspective of transferring risk, right? I have a problem that if something happens, if something bad happens, I'm going to lose money or lose revenue or have expenses go up or something. I want to transfer that risk because the premium I pay is small enough that it's worth it for me. I've done this risk management exercise in my head. Now, how does that compare to hedging, which is it's still in risk management, but it's slightly different. So what hedging is not risk transfer. Hedging is risk mitigation. It means there's a pretty good likelihood that whatever bad thing is going to happen, and I know it might, and there's probably some sort of structure where I can make sure that I'm made whole. So how does that work? A pretty good example is several years ago, the airlines, and I know here in Texas, Southwest Airlines did this, right? Airlines, their profit is very much, their expenses and therefore their profit are very much based on fuel costs, right? So when fuel costs go way up, airlines' profits come way down. So when oil is, say, at $50 a barrel, some of these airlines might go, you know what, we're going to buy oil futures or oil options or something like that, because these are hedging tools that says from now for months or years in the future, we're going to get oil at $50 a barrel. So even if fuel prices go way up, it doesn't matter, because we're still getting $50 a barrel. Either we're able to actually buy the fuel at this same price, or yeah, we're going to have to pay more for fuel, but our hedge, our options here, our futures here are actually going to go up in price also. So when you look at our revenue minus our expenses to equal our profit, right? So if our expenses go way up because of fuel, our revenue will go up because we have these options or these futures in here, which are these financial instruments that have been built specifically for this purpose, right? So that these will go up in value almost the same as this will, so our profit will be relatively equal. The other option is if they actually take ownership of the oil at that point, their expenses actually don't do anything because they're still getting this $50 a barrel or the fuel cost at the same amount. Now that's a really good example of how a company can manage their risk, because the risk is fuel costs go way up, airline profits potentially go down. So the airline has said, look, we're not in the business of speculating on oil prices or on fuel prices. We're in the business of getting more passengers on planes and flying them around the world. And we want to focus on our business that way. We don't want to worry about fuel prices, so we're just going to take that out of the equation. We're going to hedge that. That's a perfect example of a hedge. A hedge from a personal perspective is I might look at my investment portfolio and I do some diversification within my investment portfolio. I might look at it and go, I'm really heavy on tech stocks, right? So what could happen in the tech business, right? Some new technology could come out and render everything else I have obsolete, right? That could be really bad. There could be, this sounds horrible, there could be an earthquake in San Francisco and all these tech companies could be out of business for a while, and that can send tech stocks way down. So what do I have to do? I have to diversify. That's a kind of a form of a hedge, right? Or I can get, if I go, look, I have everything in the S&P 500, and it's been doing this for so long, and I'm like, oh man, I really need to diversify. I have everything in the S&P 500. I'm going to take some of this out and put it in something that generates income, like bonds or dividend-paying stocks or something that are not subject to the wild ups and downs of the market. That's something I might want to do, and that's part of diversification. That's what I do personally. Also, let's say I go back to oil and gas a lot because I live here in Texas and we're deep in the heart of oil country here. But let's say I work for ExxonMobil. All right, so ExxonMobil pays my salary, pension, basically my entire lifestyle is dedicated to what happens with ExxonMobil and therefore what happens with oil prices, right? So let's say in my 401k, I might not want to invest in Exxon stock in my 401k or have anything related to oil prices. I might want something totally different in here like tech in my 401k. I might want some other income stock in here. I might want some bonds in here because I know everything else in my life, my salary, my pension, my ability to send my kids to college, my ability to save for retirement is based on Exxon and oil prices, and therefore I don't want my actual retirement to be based on that. So I want to diversify. That's part of hedging. I might even want to take some other savings over here and divert that to something like real estate that is not correlated necessarily with oil prices and not correlated with the rest of the market here. I might want real estate that pays me some income. So that's a version of hedging from the personal side. So that's a little bit, I didn't go into all the details, but that's a little bit on insurance and hedging. Insurance, remember, is risk transfer. I'm transferring my risk onto someone else, onto some other entity or some other people that have pooled enough funds that say, if this bad event happens, we're going to pay benefits to a few of the people. Right? Hedging is saying, look, there's some sort of way that if this bad thing happens, I can get something positive out of it. Right? There are financial instruments like futures and options and other hedges like that say I can get something positive out of it and I can limit my downside. And if I can limit my downside, that's risk mitigation, right? And that's what's hedging. So there are a lot of decentralized products that are going after insurance and hedging because in the past those have been very, very centralized. And one of the whole purposes of DeFi, right, is the decentralization, is the disintermediation. So in trying to disintermediate, we want to take out some of those central parties because they add to the fees and the frictions and stuff. They've been doing a service for so long, but now we think maybe we don't need them quite as much. Maybe we can do it ourselves, right? So we're going to talk about insurance and hedging from a decentralized perspective, but to do that, first we had to talk about how it is today. So this is the traditional insurance and hedging. Don't forget to subscribe to our YouTube channel. Hit us at interaxis.io and at interaxis8, the number 8, on Twitter. Let us know if there are any other videos you want to see, and hopefully you like these.